Welcome to AlphaIndex, where we uncover the hidden wisdom behind online money-making, finance, investing, and the philosophy of wealth. Today, I'm going to pull back the curtain and show you exactly how I'd embark on a trading journey from scratch, armed with the knowledge I've gained over a decade. Before I reached a point where I could consistently generate 3 to 5 figures in single-day profits, I navigated a treacherous path filled with confusion and costly mistakes. I wasted years of my 20s and thousands of dollars that I didn't need to, simply because I lacked the foundational principles I'm about to share with you. This video is a complete roadmap. We'll start with a fundamental mindset you need to succeed, then move on to the essential tools and platforms you'll require. I'll break down the often overlooked, but most crucial aspect, trading psychology. Next, we'll demystify trading math, followed by a crash course in technical analysis, the most impactful indicators and patterns I use. Finally, I'll show you how to build and backtest your own strategies and apply everything to a real-world scenario. By the end, you'll have a clear, simplified path to start your trading career properly and profitably. The foundation: understanding market mechanics. Let's begin by setting the foundation and understanding how the market fundamentally works. Many get lost in the technical weeds, but it's really quite simple. At its core, a market chart is a visual representation of mass human psychology. It's a constant battle between buyers and sellers. When there's more demand than supply, buyers are willing to pay more, and the price of an asset moves up. Conversely, when supply exceeds demand, sellers are forced to lower their prices, and the market moves down. This dynamic interplay between supply and demand is what creates volatility, the big, rapid price swings that create opportunities for traders like us. Licensed by Google. As traders, our job isn't to predict the future. It's to identify these imbalances and capitalize on them. We enter the market at a certain price, and if our thesis is correct, the price moves in our favor, and we exit at a higher or lower if shorting price. The difference, multiplied by the number of units we bought, becomes our profit. For example, if you buy 100 units of a stock at $200 and it rises to $205, you've made a $5 profit per unit, totaling a $500 gain. This is the simple math behind every trade. Now, let's zoom in. Most people think of investing on a yearly scale. They might buy into the S&P 500 and hope for an average 10% return over a year. While this is a viable strategy for long-term wealth accumulation, it requires a significant amount of capital to generate a meaningful income. This is where intraday trading comes in. Instead of looking at an entire year's movement, let's zoom in on a single day. You'll see dramatic movements that can generate returns far exceeding an entire year of traditional investing. The same $100 of risk that might make you $10 in a year could potentially make you $300 or more in a single day. This is the power of leveraging short-term volatility. My most profitable trades are the ones that follow a strict, repeatable process. For instance, in a recent trade, I anticipated a significant drop in an asset's price. I entered the market, and as the price moved down, my profits soared from $2,400 to nearly $4,000 in just 2 hours, all while risking only $500. This isn't a boast, it's a testament to the power of a repeatable framework, essential tools, and the right mindset. To get started, you'll need 3 key tools. TradingView. This is your command center for all charting and analysis. It's where you'll spend most of your time studying the market. A trading platform. For crypto, I prefer Bybit or Blowfin. For stocks, many of our community members use platforms like TopStep. Choose a platform that suits your asset class and offers a demo account to practice with. A trade journal. This is non-negotiable. I'll provide a template for you later, but a journal is essential for tracking your progress and learning from your mistakes. Once you set up your TradingView account, navigate to the superchart to get a clean canvas. I recommend a 2-screen setup, TradingView on one monitor for analysis and your trading platform on the other to execute trades. Understanding your trading instrument is crucial, Every trade involves a pair, an asset's value measured against another, most commonly the US dollar. For instance, you might trade Solana against USD, where the value of Solana fluctuates against the stable value of the dollar. Managing these pairs is made simple with the watchlist feature on TradingView, allowing you to quickly flip between different assets. Charts can be displayed in various formats, but the most common for day trading is the candlestick chart. Each candle tells a story about price movement over a specific time frame. A green candle signifies that the closing price was higher than the opening price, while a red candle means the opposite. The wicks, or shadows on the candles, show the highest and lowest points reached during that period. By changing the time frame from a 1-minute chart to a daily chart, you can see the same price action with more or less detail. A daily candle on a daily chart represents an entire day's movement, whereas a 5-minute candle on a 5-minute chart shows a smaller piece of that same movement. This ability to zoom in and out is vital for finding short-term opportunities within a larger trend. Psychology and risk management, the bedrock of trading. This is the most critical section of this video. Your mindset will determine your success. I've identified 3 major misconceptions that sabotage new traders. Losing is inherently bad. Being wrong is bad. Making money makes a trade good. Let's dismantle these. The market is a game of probabilities. When you enter a trade, the price will either go up or down. Your job is to create a repeatable process that ensures your wins are statistically larger than your losses. Think of it like this. A good trade isn't one that makes money. It's one that follows your plan and manages your risk effectively. A bad trade is one that ignores your plan, regardless of the outcome. The first step is always to define your risk. Before you place a trade, you must know your risk-to-reward ratio. For example, if you decide to risk $100, you should be aiming for a potential profit of $300 or more. This is a 1-to-3 risk-to-reward ratio. Your risk is defined by your stop loss, the point where you exit the trade to prevent further losses. Your reward is your take profit, the point where you exit to secure your gains. Let's do the simple math. Say you want to risk $100. Your entry price is $15.352, and your stop loss is at $15.252. The distance between your entry and stop loss is 10 cents. To risk exactly $100, you would buy 1,000 units of the asset. $100, 10 cents. This ensures your potential loss is contained, even if the market moves against you. You must embrace the fact that you will be wrong and you will lose money. These losses are simply the cost of doing business, the entry fee, to be in a position to win big. By meticulously managing your risk on every single trade, you are ensuring that your process, not luck, dictates your long-term profitability. You're not trying to be right on every trade. You're trying to make sure that when you are right, you win big, and when you are wrong, you lose small. Technical analysis, a crash course. Now that we have the proper mindset and tools, let's talk about how to read the charts. While there are a million indicators, I focus on a handful that provide the clearest insights into market sentiment, trends, and trend lines. The first thing I identify is the market trend. Is the price generally moving up, uptrend, or downtrend? I use trend lines, lines that connect a series of higher lows in an uptrend or lower highs in a downtrend. As long as the price stays above an uptrend line, the trend is considered healthy. A break below it often signals a shift in market direction. Fibonacci retracement. The Fibonacci retracement is one of my most powerful tools. It's based on a mathematical sequence found throughout nature, from the spirals of a seashell to the growth of a plant. When applied to a chart, it reveals key levels where price is likely to pause or reverse. You apply the tool from the lowest point of a trend to its highest point, or vice versa. The most important levels are the 50% and 61.8% retracement levels. Price often pulls back to these levels before continuing its original move. This provides a high probability entry point to place a trade with a tight stop loss. Fair value gaps. A fair value gap is an area of a chart where price has moved so rapidly that it leaves a gap in the price action. They are created by large, impulsive moves where the buying or selling pressure is overwhelming. I look for 3 consecutive candles where the wick of the first candle and the wick of the third candle do not overlap the body of the middle candle. These gaps often act as magnets, and price will frequently return to fill them before continuing its move. Identifying these gaps gives you a high probability area to look for a trade setup, as they represent a strong imbalance between buyers and sellers. Building your strategy. A strategy is a combination of these elements. You might create a strategy that says, I will only enter a trade if the asset is in an uptrend, pulls back to the 61.8% Fibonacci level, and has a fair value gap in that area. Once you have a strategy, you must backtest it. TradingView allows you to replay past market data so you can see how your strategy would have performed. This is where your trade journal becomes invaluable. Track every single backtested trade, noting your entry, exit, risk, and reward. This process helps you refine your strategy and builds the confidence to execute it in real time. Conclusion: trading is a skill, not a gamble. It requires discipline, a solid understanding of risk, and a repeatable process. Don't be swayed by instant gratification or lucky wins. Focus on mastering the principles we've discussed today. Embrace the probabilities. Understand that losses are part of the game. Master your psychology. Your mindset is your greatest asset or liability. Control your risk. Define your risk to reward ratio on every single trade. Study the market. Use technical analysis to identify high probability setups. Backtest your strategies. Prove to yourself that your system works before you risk real capital. This is the AlphaIndex approach to building wealth. If you found value in this video, please give it a like and share it with someone who needs to hear this message. Don't forget to subscribe and hit the bell notification so you don't miss our next video, where we'll dive even deeper into building a repeatable trading system. Welcome to the AlphaIndex.